Elevator Pitch with Jonathan and Mitch is made possible in part by Pearl House, a Van Barton Group holding.
Hey, Mitch.
Hey, Jonathan.
Are you aware of what a get is in the media world?
It's got to be huge.
It's very big. We have a get of gets.
Today, in our studio,
In our studio right today, we're going to have Peter Braffman.
Peter Braffman, Managing Director at GCM Grosvenor.
Unbelievable. How lucky are we?
That's a serious get.
The views presented in this podcast are my own and may not represent the views of GCM Grosvenor or others. Also, any specific names are provided only as example. Further, past performance is not indicative of future results. Hi, I'm Peter Braffman, Managing Director and Head of Real Estate at GCM Grosvenor, and I'm about to be on Elevator Pitch with Jonathan and Mitch. Very excited to do it. I'm going to talk about a little bit of my career, talk about what I do, talk about the evolution of the real estate industry, and I hope you enjoy it.
Welcome to Elevator Pitch with Jonathan and Mitch. I'm Jonathan Schein.
And I'm Mitch Berkey, and we have here a very special guest today.
Peter Braffman. Now, Peter, before we get started, the most important thing is, how do you pronounce your company's name?
That's a great question.
Is it with a silent G or a silent S?
It's a silent S.
Because everybody's always saying Grosvenor.
They do, and I'll say it's Grosvenor, silent S, and they'll not, and they'll say Grosvenor.
Yes.
Yeah.
It's Grosvenor. So
GCM Grosvenor.
Exactly.
Are we clear on that? GCM Grosvenor.
I think we've got that down.
We've got it down. Thank you.
You're welcome.
So, Peter, why don't you just give us a little background on GCM Grosvenor and what you're doing today?
Okay, so GCM Grosvenor is an $80 billion or so alternative asset management firm. We manage money across all alternatives, so hedge funds, through real estate, obviously, private equity, infrastructure, credit. It's been around since 1971. It's headquartered out of Chicago, big office in New York, obviously, that's where I am, and then offices around the world. And we manage money for largely institutional capital, almost exclusively. And this is like pension plans.
Yeah, tell us about the institutional capital.
Yeah,
And the capital, this is exclusively in the real estate column.
well, actually, the
For you.
Oh, so I'll talk about real estate, but also just talk about the broader firm.
Yes.
So the broader firm is actually that institutional capital, and just the history of it. It started as a hedge fund of funds in Chicago in the 1970s. They acquired the private markets group out of Credit Suisse. That's where I came from. That was real estate, private equity, infrastructure.
And you were there at Credit Suisse at the time?
I was
and
there.
moved, slide right in?
Exactly. So that acquisition started it was in 2014 is when it was finished. And so Grosvenor became kind of a diversified firm after that. But both sides of the firm, meaning publics and privates, really had the same kind of DNA, which was they worked with institutional capital and managed their money in terms of getting access to the alternatives, particularly at a time when that wasn't that easy. We'll talk a little bit about the history of that. But, back then, institutional capital was looking for access to the alternatives, didn't know how to get it. And a lot of these groups grew up, and Grosvenor was one of the most successful ones, and Credit Suisse as well, in managing this and finding opportunities in funds and other, alternative asset classes. So that's really how it came together. It really kind of looked very much the same way. What's a little unusual, a lot of investment management firms are structured as commingled fund investors. We were mostly a separate account investor. And I say mostly because it's not only that. We have commingled products. But mostly we manage money strategically for these big institutional capital sources where they're looking to do something, that they can't do themselves. When you think about our investor base, they're great. They're big. I'm not going to name any names, but they're...
We'll get you to name some
Yeah,
names.
well, you could try, but you can imagine who they are. Like they're some of the biggest, top 10 firms in the world in terms of assets under management.
I mean, isn't that when you say institutional, do you also mean sovereign wealth funds?
I do.
You mean some of the bigger pension funds?
Yes, it's largely both of those. It's largely public plans, pension funds, largely sovereign wealth, some corporate pension plans, all looking for this kind of, I guess, solution.
But Peter, go back to your role at Credit Suisse. Yeah. Were you essentially doing the same thing? So it was an easy switch?
Absolutely. So it was very much the same thing. I started the practice at Credit Suisse in 2010. Now we had a very big private equity business at Credit Suisse. We had a growing infrastructure business. They didn't have a real estate. So I came to start that.
And how did you come to start real estate? From where did you start real estate? You didn't just walk into, hello, Mr. Credit Suisse or Ms. Credit Suisse, I'd like to start a real estate practice. How did you get there?
That is true. I did not. That was a moment in time. It was just post-GFC. Before that, I was at Zurich Financial Services doing something actually quite similar.
Also alternatives, yes?
Also alternatives.
Yeah.
We had a hedge fund, private equity, real estate team. I was in the real estate team, obviously. And again, focused on access to real estate, both directly, we're buying and managing assets directly, investing in funds as well, and doing, all forms of GP investing too. So very open architecture, very innovative. I love my time there. Post GFC, that was a tough time. We weren't making investments. So eventually you answer the call. And someone called and said, would you be interested in having this conversation? I'd met Credit Suisse, who was called the Customized Fund Group years before. So I knew them a little bit, but didn't know much. I knew they didn't have real estate. And they had a very large pension plan. Again, this is the strategic nature of it. Very large pension plan who they're working with. And they said, together they said, we want to start a real estate practice. Focused on something that was a solution for this LP.
So they had the need and they found you?
Exactly.
Did they lift out a team or was it just you?
Just me.
Okay.
Yeah, so it was just me to start it, get it going. They seeded me, or us, I should say, with a couple $100 million to start. And then we started going. And again, like the traditional CFIG model, which was more of a investing in funds, investing in doing co-invest, mostly focused on early stage managers, which we'll talk about, emerging managers.
Yeah.
That was
We'll get into that.
Yeah. So that was the idea.
And how long did it take to really get traction and take off?
That's an interesting question. So the idea was, let's build it. Let's start, hiring some people, made some wonderful hires, some incredible people, started the practice, built a portfolio, and then started attracting new capital. And this particular LP was great about that. They wanted us to raise other capital around them and grow this business. So it really started, growing quite well. And then in 2012, 13, Credit Suisse says, we're out. We're going to sell this business. We're going to sell other businesses. So they were, disposing of or selling multiple businesses. We were one of them. And so we were sold in a process to Grosvenor. And then, so this is, I say, a little bit of a pause. 2014, the transaction was finished. And I think once we were at Credit...
So you went along with the unit that was acquired?
Exactly.
Okay.
So the whole unit went over. We got new office space in the GM building because we didn't have any.
Pricey space.
It was, but not so bad. We got a good deal.
You're in real estate after all.
Exactly.
Well, let me ask this, Peter. Yeah. Why was there this need from the institutional investor to go towards alternatives? And can you define how alternatives are separate from what they were investing in?
Great question. And if you don't mind, I'm going to take a little detour on that.
Sure.
So you almost have to go back to the late 70s, and pension plans were around and had been around for quite a long time, but they really were not investing meaningfully in anything other than annuity-like products. It wasn't until ERISA that transformed kind of the prudent investor standard for what, an investor, an institutional investor.
It expanded it.
It totally
yes,
expanded
yes.
it. And I like to say it's always about the capital. And that capital, institutional capital, started flooding into or moving into the broader markets. And I'm not talking just even alternatives. This is early before alternatives. This is like the stock market. So this is, and if you think about we're going to all date ourselves. I still remember this.
Can't hide it. We can't hide it.
We can't hide it, yeah. We don't want to, right?
It's all good.
Love it. I still remember this cartoon. Call it 1980. This shows, I think it was the Wall Street Journal. I was in high school, I was studying something. And it showed this stockbroker standing over the crib of his grandchild. And the market Dow had just got over 1,000. And he said, maybe when you're my age, it'll be over 2,000. And what none of us knew was that all this money was moving into the financial markets, and the modern era of financial markets really began. All option theory really started moving, all the quantitative models started changing, and it kind of been reformed. So all of a sudden, over the next, I don't know, 20, 30, 40 years, $55 trillion of capital flows.
That's trillion, T, with a T.
Trillion with a T.
Yeah,
with a T.
flowed into the markets and really transformed it. That, now, why was so? One, the restrictions were lifted off.
May I just say, is that domestic capital or was that
That is
global?
domestic. That's
Just
domestic.
domestic
Yeah, all
capital.
domestic, yeah.
Okay.
Tremendous amount of capital flowing in. Another thing was happening at the same time was, again, a special moment in time. Interest rates started their long-term secular downward trend from 15% in 1980 down to almost zero a couple of years.
We all remember that double-digit era.
Think about that trend. So all this capital coming in and all this incredible, if you buy something at 15% interest rate and sell it at anything lower, you're going to do great. It was an incredible moment in time.
Was it almost too easy to make money then?
Yeah, it was. And that's when so what happened was the financial markets became institutionalized. And I think it's another word we should use, meaning that it became much more efficient. A lot of very smart people started going into the business. A lot of technology went into the business. And getting returns became harder. It became just harder. So, and interest rates started going down. As that happened, when you think about it, if an actuarial rate for a pension plan to get their returns is 7 or 8% or 9%, and interest rates are 15%, you're doing great. Yeah. When interest rates are 7%, 6%, it's much harder. 5%, 4%. So literally, if you map the allocation to alternatives against the decline in interest rates, it's perfectly inversely correlated. So you just started to see, or perfectly correlated, however you want to look at it, basically as interest rates were declining, they needed to find more returns. And if the public markets became too efficient, the private markets and the alternatives became the next frontier. And so that really was kind of the evolution of really our whole business.
This episode of Elevator Pitch with Jonathan and Mitch is made possible in part by Pearl House. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
Jump back to CS, Credit Suisse divests,
Yes.
and you now have a new business card.
Yeah.
You're at GCM Grosvenor.
Yeah.
Okay, so how did life change?
So Credit Suisse was a wonderful firm in many ways. It really had tremendous entrepreneurs. You think about DLJ, that was Credit Suisse. First Boston, that was Credit Suisse. There were all this incredible talent, never quite merged well together, and that's when groups started to get spun off. So what happened for me at Credit Suisse was, there was just conflicts. So we had a direct real estate shop in house. We had other real estate practices. So if you found an interesting opportunity, other groups could say, actually, that's my opportunity. Not just
A little bit of this?
a little bit of that.
Some territorialism.
It was. I mean, my background was at Goldman Sachs, very different organization. It wasn't like that. There were no these turf battles. And look, people were nice. It wasn't like they were being difficult. It's just this
It wasn't Glengarry Glen Ross.
No. It was just look, this is a.
You don't want the steak knives. You don't want the steak knives.
So it's frictional costs. There's certain things I couldn't do. And Grosvenor was sort of that was it. There was no other real estate practice. The other thing is they had technology and things that they were doing that I learned from. and we'll talk about that in terms of.
So did that take what you're doing to a new level because of those new tools?
Yeah, absolutely. So, I mean, the biggest tool for us is I knew I needed to move away from, again, that traditional fund and co-invest model. It's a hard model. Again, a lot of when you think about the institutional capital that's out there, they became very sophisticated over time. Really smart, really talented. They had access to everything. They don't need me to find a fund. They need me to find something new and interesting that they can't get access themselves. And so emerging managers is a great way to do that. But the fund model, again, is not necessarily the most efficient model for that, I think. So what Grosvenor had, they had done a lot of seeding. They seeded on the hedge fund side. They had a real practice in that.
Now, Grosvenor has put in money on some serious household names and really watched them grow.
Yeah.
So what's the process by which you and your team have meetings, meet candidates, and then decide where you're going to write a check?
Interesting question. So we've seen 1,600 different teams and business plans since we started. So we have an open door policy. We see everybody. And
Wait, say that number again?
1,600.
1,600.
Yeah. Okay. And we keep, that's the other thing. It was nice. When I got there, it was a blank slate. So it's kind of fun to have a blank slate. You're just like, okay, let's track everyone. So we have a lot of good data. We track all the different teams that are out there. We look at the market. And our LPs are, again, household names. They see all these groups. They send them to us. So between proactive sourcing, open door policy, our clients, all this stuff, we just see a lot. And so you go.
So the way you operate at Grosvenor, should I say GCM Grosvenor? I never know
You can
which.
say Grosvenor. I mean, to be fair, the royal family Grosvenor is a distinction. So you can say GCM.
Or GCM.
Yeah.
The way you place your capital is actually you raise capital from institutions and then funnel that into basically.
It's a horrible word.
Okay. Is that a horrible word?
No, it's not.
Okay, you invest.
No, but as opposed to a simple world of investing on an asset basis,
Yeah.
you're emerging with you're investing in a team.
Well, that's true.
Emerging managers, as it were.
You're right. No, you're both right. I mean,
But wait, hold on. We're both right.
That's never happened before.
Never.
That doesn't
Never.
happen.
this is
Wow.
a moment.
Can I just take a moment?
When did this?
Yeah.
Okay.
Deep breath.
But so that's kind of the fun part of this kind of, I call it's open architecture, which is, yes, like we're investing in certain asset classes that we really like, certain strategies we really like. Most of our practice, and again, that's the technology I was talking about. Now we go direct. Most of the time we invest directly in assets as opposed to in a fund. It's about 80% of the time we're investing in assets.
Really?
Yeah.
So what role are you playing? And you have the classic equity and then the operator. So what's your formula?
Our role is we see all these teams, we find all these teams, we diligence a number of them and decide which ones we want to invest with. Our investment structure is, hey, typically we'll start with a joint venture, something programmatic where it's a partnership. We're going to say, hey, we're going to build, and these are usually teams that have spun out of other firms. They want to start a new platform, and so we'll buy assets with them. We will maybe provide them working capital as they need to grow their business. We may seed their funds.
So you'll invest at the platform level with an opco, with an operating company?
We will. Most of our process is, hey, let's buy assets with them, and as they grow their third-party business, that's the key.
Let them prove themselves to you.
Let them prove it.
Yeah.
Right. Then we'll seed their fund business. We'll actually contribute assets to a fund. We'll take a position in that fund.
How's the elevator pitch fund coming along? We start that
Fantastic.
yet?
We haven't
We'll talk
pitched.
to
We haven't
Peter
pitched
about that
Peter
later.
yet.
Yeah.
That's-
No, that sounds fascinating.
Yeah.
So
No, it's
you're working at multiple levels.
But I think you raise a good point. We should come back to it, which is
Yeah.
where the business is generally going, not just our business,
Yeah.
but the broader business.
Yeah, there seems to be a big consolidation in that world.
There's a big consolidation happening, and also, again, as LPs are getting more sophisticated, again, when you think about LPs, their access was like, just find me funds. Then it was like, you know what? We have a lot of funds. We just want to work with some funds. And then eventually these LPs are saying, you know what? There's some of this we could do ourselves, or we don't have to do it in a fund format. We could buy assets with operating partners. And maybe since we are the engine for these firms, we should take a piece of these businesses, hence the staking business. So what our practice is kind of mirrors that reality, which is we're like, look, if we're going to get these teams going, we want our LPs to benefit from the growth of those platforms.
So for the benefit of your LPs, I would imagine, and please share, you look to diversify because you don't want to put too many eggs in one basket with any one opco or one fund.
Correct. So we have, since we've started, we've invested with, I think it's 50, maybe today it's 51 teams. Currently, we're working with 29 of them.
So you actually have exited from 20 some odd of these
Exactly.
firms. And how many investments do you usually make per year?
Well, okay. So I'm going to define investments a couple of ways.
Okay.
Last year, we saw 316 different opportunities of teams we were looking at. We got close with 60 of them. We wound up investing with 20 of them, and 5 of them were new teams. So it gives you an order of magnitude. But
So let's look at that number again.
Yeah.
You talked to 316.
Yeah.
And there's 360 or so, is it 365 days in a year?
Yeah.
So you're talking every day of the week
every
with
day.
candidates around the country.
Right.
And then you end up selecting 5
New
out of
ones.
that group.
Yeah.
Wow.
It's almost like acting in auditions.
That's a beauty
That's
contest.
like getting a show.
It is what it is, and it's just like it's hard because we have a bigger book now, and we have to figure out how and who we want to work with. And
You can afford to be picky.
we can, and we need.
It's
to
not a
be-
negative. I mean, it's
Yeah, we
it's what
need-
you deliver for your LPs.
So when do you know it's time to exit?
So that's it. So
This interview or
He's already gone.
So there's, again, multiple answers to that. By the way, I do want to say one other thing, though. That's programmatic investing. So we did, 5 new ones, 15 existing ones. But we also, because we have these programmatic joint ventures with these teams, like we are seeing all their deal flow. And we're also investing at the program level or the platform level in multiple deals a year. So last year, I think we did about 100 discrete real estate deals. And our team is underwriting those deals as well. Again, we're relying on these operating partners to find these deals. They're the entrepreneurs. They're the ones who are bringing this to us, so we can leverage each other, but we could help them.
So you're on the investment committee as well.
We're an investment committee in the sense until they become a fund manager.
Okay.
And if they become a fund manager and we, seed that fund, and then the only thing that's fair, the only reason they want to work with us is because we're going to let them fly. At that point, we lose discretion. So I think that's a fair trade. We lose discretion, but we share in their upside.
And as I said, following up, how do you exit? What is the plan?
So part of the exits are,
is it pre-planned or is it based on performance,
Pre-planned.
perhaps not going the way you'd like?
generally pre-planned.
Okay.
So some seeders use the word seeding really very literally. They'll seed a team, they'll give them some little money, they'll take a piece of the business. We kind of look at it a little bit differently. Like at these early stage businesses, there's no value in these businesses, and there's a fight over. So we don't want to do that. I think it's a good business, what others do. Our approach is we want to continue to support them as they grow. So we will share in the revenues. It's called just revenue promotes. We'll share in the GP economics. On a series of funds that they raise or joint ventures that they raise where they have third-party capital. As those things pay off, they sell the assets, it's a natural exit. So we don't have to do anything. So it makes it actually quite simple. If we actually own a piece of the opco, and sometimes that's going to happen, that's a much more liquid thing, and that's going to take over time.
This episode of Elevator Pitch with Jonathan and Mitch is made possible in part by Pearl House. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
We have operating partners, operating companies, opcos, that make up a nice chunk of our viewership here.
Yeah.
So they're listening to what you're saying,
Yeah.
and they're going like this, how do I get in on this GCM programmatic gravy train?
Yeah.
So what boxes do they need to check in order to get your attention?
I mean, it's funny. What's happened over time is, not surprisingly, sometimes I just get an blank email that says, hey, blah, blah, I'm so-and-so, got the strategy, and we're willing to give you a piece of the business. Like, hold on, thank you very much. But, I got great advice from he's a friend of mine now. He's a quasi-competitor, wonderful guy out of Chicago, who said, listen, Peter, like, I've been in this seat before. It's a tidal wave. Like, you got to be fair to you, your team, and to these people. You have to come in with a view of where you want to be, what you want to do. So we have a box. We know what kind of things we're looking for. we're going to talk to everyone. We have open door policy because you never know. There are times like, I don't want to do this asset class. I don't want to do that geography. I don't want, and I'm like, we did it because they were so compelling. They taught me something I didn't know.
And what was it that your daughter said to you once when she was a little girl and she visited you at work and she watched your work?
Oh, you remember this? I can't believe you remember this. She's like, all you do over there is talk.
So,
I can't believe you remember that.
so you also invested in, you seeded funds.
Yes.
Right? And do you remain an owner in the stakes of those funds? And you said you've had some pretty big success
We
stories,
have.
which I'd love to hear about. We'd love to hear about.
Yeah, so like and by the way, again, this is the evolution of the
Yeah.
process. So when we first started doing this in 2010, we were not taking stakes. So it was just, we were more of a fund investor. And we watched these businesses grow and we're like, kind of blew something here. And we also,
And you're seeding those businesses
Today.
with your investment capital. No, back then on a deal basis. So maybe why not get in on the platform?
so yeah, we should have.
Yeah.
And one group in particular came to me and said, Peter, I'll give you a piece of the business. Meaning, and by the way, just to be clear, when I say give us, it really all goes to our LPs.
Right,
Like,
of
we don't
course.
keep it. Some seeders do. Some seeders are like, well, this is our value. But it's like, it goes to their returns. But we also noticed that a lot of the most successful groups that we worked beforehand, they were backed by someone else. They were doing the same thing that we're doing today. And I was like, well, why don't we do that? Like we should, we know these groups. The other thing is we also started learning that, we didn't have control. And as a fund investor, you don't have control. Right. And so it's one thing if they're very established funds, even then they make mistakes. Early stage funds could shoot for the fences. You got to be careful. So we realized like we need more control early on. So that was the other reason we went direct and said, we just got to get closer. So yeah, like some of the groups that we've worked with in the past have become household names. They're massive. They're big. Not Blackstone. They're amazing.
Can you name any of them, or should you not?
We don't want to make you feel uncomfortable
I
any
don't
more
know.
than we need to.
Yeah. No, I love it. I have no idea.
So share with us, what's any given day look like for you, aside from taking your valuable time out to be with us today, which we truly appreciate.
I love
but, I mean, and we're joked about you talk to a lot of people. Yeah. But what do you do with your team? Share with us.
And your team has grown.
Team has grown a lot. So there are a lot of things. Let's see. So what do we do? Yes. So we every month. So I say I want to get to a day. So I guess you could say this every day, but every month, just to give you an example, we have 81 pipeline calls. So 72 with our operating partners, talk about all the deals they're seeing, and 9 with our LP partners, and because we want to show them what we're seeing.
And that's just discussing existing deals, not the 360
Exactly.
meetings that you take annually
Exactly.
with potential
Right.
opcos.
So you can imagine every day there's probably just 1 or 2 of those a day.
And how long do they last? 60 minutes, 30 minutes?
Yes, like that's
Okay.
exactly right. Like 30, like we usually block out 60. It's usually less. Some of our operating partners, like it'll be a Sunday night, they need an answer on something they've just originated. It depends, but it's pretty regulated. We also, as a team, meet every Monday and Thursday to talk. Monday is every like underlying deal that we're looking at. So all the deals that we're seeing through our operating partners. Every Thursday is every kind of interesting new group that's come in. Are we thinking about them? What's going on? So that gives you an idea.
How do you keep track of it all?
I don't. Colleen.
So that brings up another point. You actually have your own conference for this.
We do. So we have 2 conferences. We have the broader GCM conference, which is the consortium, SEM. It's been combined into one conference. We see the world. Like it's all asset classes. We all get together. We see all LPs in the community. We see all GPs. Usually between 800 and 900 people come. We do that.
And do you carve out time for the courtship process for potential newbies?
Absolutely. So all these groups file in. So this is open to any kind of a manager that is interested in talking with us. And then
It's like the old days when you come to see the king and you bring a goat.
bring
Similar
a
to that.
goat. That's a funny concept.
I always brought a different animal every year. Every year I brought a llama.
Well, that's you being you.
Do you watch Severance? Baby goats. I don't know. Anyway, so, but we also now have our own conference just for the community that we built, where it's just all of our LPs and all of our partners, GPs, get together and we sit and talk for a couple days about everything. So that's a lot of fun.
Now, I can see that you truly enjoy what you're doing.
love what I'm doing.
You know, you can't hide that, and that's a beautiful thing. But let's talk about the journey,
Okay.
how you got there.
Okay.
Because your story is fascinating, and it starts with some humble beginnings. So share a
Yes.
little bit.
So,
And not to mention, you know, your siblings that all became doctors, and you're the black sheep,
Yeah.
that you're not a doctor. But that's a whole nother part of it.
it's true. Big part of the story.
Still trying to prove yourself.
Yeah, I really
Still
am.
trying
Well,
to
we're
prove
always trying to get
Why
the
did I get a
acceptance.
law degree and a business degree?
Right.
I had to go to school for 4 years. They went to school for 4 years. So I had to go to school for 4 years. So yeah, grew up in Queens, Forest Hills. My wife likes to say Rego Park.
Yeah, yeah. Know the area well.
Yeah. Yes, you do. And my parents were both teachers, both first generation. They came here. My dad from the Lower East Side, my mom from Brooklyn, yeah, my siblings were all doctors, and I was going to become a doctor too. I was like, I'm going to become a doctor. And people say, why did I go to Rochester, University of Rochester?
Because the beaches there are beautiful. That's why
Yeah,
you
that's
went,
right. Yeah, for about a week in the summer, they're really nice. Actually, it's a beautiful place.
No, love Rochester. Love Rochester.
Yeah, it's a great barbecue, great wings, and it's a lot of fun. But I was a pre-med, and that's what I wanted to do. And I was absolutely miserable. And then I realized all my siblings were miserable too. They've had great careers, but at the time, I just remember talking to them, like, medicine was changing a lot. And so as I go, what I need to do for a little while is I just need to stop. I just need to learn and try something different. And actually, one of my brothers took a year off while he was in mid school. I think he was just needed a moment.
Now, you worked before you went to graduate school.
I did. So after college, what I did...
That was when Rochester was undergrad.
Rochester was undergrad. And then after I graduated, I took my MCATs, did all the stuff prepared for it, because I told my parents I'd do that. I wanted to. And then
Until you broke their hearts, yeah.
Until I broke their hearts. But I did all sorts of things up there, and one of the things I did was I interned for a brokerage firm, and I was fascinated by it. I was like, I just want to learn this stuff, because I didn't understand it. And I started auditing courses in finance, and I found it really easy. It was just like great. And it was early. It was like a fascinating time. So then I wound up, getting a job down on Wall Street, and it was like this little boutique investment bank. And I always tell people, it's sometimes the best way to start. The big training programs are phenomenal, but the little places you just get to do everything. And I got to do everything, and I wound up learning. It was a similar kind of business. We were managing money for institutional capital in real assets, generally speaking.
Now, what about that experience led you to a 4-year JD MBA program?
I just
4 more years of school.
I know.
After you had a regular paycheck.
The Braffmans like to study.
I think that's true. I mean,
Education's important.
The funny thing is, I remember before I did this, my dad said, become a doctor. I said, I don't want to become a doctor right now. He said, become a dentist. I'm like, I'm not going to become a dentist.
That's even better.
No,
the old
become a
joke.
lawyer. I'm like,
Yeah.
no. I said, I just need to take some time. So all of a sudden, after 4 years of working, he just says to me, when I decided to go back to school, he's like, why are you doing this? You could just stay. You're doing great. And it was like a great time, but I just realized I had learned all this stuff, and it was incredible. And the truth is, I didn't need to go back to school, but I had questions. I just had a lot of fundamental questions about things, and I said the best way for me to round out my experience is go back to school. So I went to Northwestern, went to law school and a business school. And a lot of the lawyers, people I work with were former lawyers, and they influenced me heavily. They were brilliant. I was like, I want that. I want that. I want to understand that. And the best thing that happened was I met my wife. So I met my wife there.
There you go.
It's all good.
So it all worked out great.
And so now today.
So today. And then after this, I was a lawyer for a couple of
So
years.
you were in big law for a couple of years.
Yeah, I was at Kirkland for a couple of years.
Oh.
And then I went to Goldman. Both amazing experiences, some of the smartest people I ever met. But it was those experiences in particular that taught me that also I was like, you know what? I want to get on the principal side. I loved being an advisor, which is really what you are when you're a lawyer or a banker, but it's someone else's deal. And, you do the deal and then you move on.
You were done living vicariously.
I was. Yeah. And honestly, that's why I went to Zurich. It was like a very special moment at Zurich. They were changing their platform. And for me, it was an opportunity to go direct, to actually say, hey, what is it like to actually be an investor? That's why I like to say, until then, I was a finance guy. At Zurich, I became a real estate guy. But it was there, like I was at a special moment in time where, again, we were seeing all this fund proliferation, all these managers. Blackstone was still small. Everyone was still small back then. And so this is kind of a moment where I was seeing all these groups grow, and we were doing all these different things. So I'd kind of seen kind of how the industry grew.
Let's just reflect on that. Blackstone was small then.
I remember when Blackstone started. I remember when BlackRock didn't exist. Like, so when I first started back in the 80s, there was none of these firms didn't exist. It was, I mean, it was, obviously Lehman was around and other groups like that, but it was like JMB on the real estate side.
Yep.
Right?
Big syndicator.
Right, big syndicator.
Yeah.
And that's what I started doing. So my first job out of school was working out old syndicated real estate partnerships. You learn a lot when you work things out. And so I saw.
Oh, after the Tax Reform Act, there was a lot of that work.
Well, that's
out.
And then
Right.
the
That was your timing. Yeah.
and then the RTC, obviously, and a lot of the workouts.
Right.
So
Exactly.
This episode of Elevator Pitch with Jonathan and Mitch is made possible in part by Pearl House. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
you talk to, 360 different individuals, firms, organizations a year. What's really attractive right now? What are you looking at? What are the things that pique your interest?
Asset class and markets.
Asset classes and markets. So what the general thing that interests me, so two things. First of all, when I see a team, what interests me is that they're great investors, but they're also great business builders. They understand that what they're building is not just a fund or hey, this is a great deal, but they want to have grow a business. And believe it or not, when you see 360 groups a year and all of a sudden, about 20 of them will fit that box really well. There may be a little bit more, but my point being is that getting that combination is not
It's
always
less than
easy.
10%.
Yeah. I mean, I'd say half the groups I see, all the groups I see are very smart. Half the groups I see are excellent investors, like really good, maybe more. And then some are very good, like they understand that they need to build a business, they don't know how to do it. It's going to take them
Well, they
a
may
while.
not have the infrastructure yet to do it.
And they certainly do. They certainly will not. And if you come from a large firm and spin out, very often you were siloed away from the capital, you were siloed away from the nuts and bolts. So you've learned a lot of things, you've built some wealth, but you don't know what you don't know. And so a lot of times it's testing to see if people understand what questions to ask. I guess I'd say that 20 or so I kind of said, the truth is that number grows quite a bit over time because what winds up happening is there are teams we talk to and we talk to and we talk to, and 4 years later we're like, okay, now you're ready.
So let me ask you about that. So when you turn someone away
Yeah.
because they're not ready yet, do you tell them to bring back the broomstick of the Wicked Witch, or do you give them any pointers?
We do.
Do X, Y, and Z, and
Yeah.
then you'll be in a position to talk to us?
Absolutely. So there's a big mentorship conversation that goes on. We need to be honest. We try to be honest. I mean, sometimes it's a spectrum. Sometimes there are things you really need to build. But this goes to your second question, or the question you started with, what are we interested in?
Yes.
Asset class and
Asset
market.
classes. A lot of times it's just sort of like, hey, what you do is great. But the truth is, we're not.
It's not in our strategic plan.
It's not in our plan.
Yeah, yeah.
And so, for example,
You are a fiduciary,
we are
after all.
fiduciary. So in many ways, what we're trying to do is build teams or help build teams that we think can be successful in this environment. Not only could find interesting asset types, but could grow businesses that our investors could invest in at some point that are going to become something that's interesting for them. And so that's the two-prong of where the business is going. On the asset side, it's going more towards, I'd say, heavily into middle market and heavily into nichier type asset classes. So, and I'm not going to knock different things, but for example, a traditional residential strategy is building apartment buildings or garden-style apartments. They're taking things from Class B to Class A. That is a great strategy, and there's tons of groups doing it. And so I just tell groups, if you're going to do that, that's going to be tough. Yeah. Because it's tough for a lot of LPs have access to that. So again, it's always about the capital. My advice to them is the big institutions don't need what you're doing. And we probably don't need what you're doing. But there's other forms of capital out there that do, and that's kind of an interesting part of I do want to talk about. So
There are new capital sources
there are
coming in.
great new
Yeah.
capital sources out there that are going to compete with the institutional investors. So again, nichier asset classes, adjacent asset classes. I like to say that real estate houses our economy. So houses how we work, how we live, how we get stuff. And those things change. So look at what happened to retail over the past 10 years and what happened to industrial. Look what's happening to office right now. Looks like happening to all of a sudden how we travel and how we do things. So those asset classes are changing, and we call them adjacencies. So they're adjacencies to traditional asset class buckets that it's storage or parking or outdoor storage or whatever it is. There's all this stuff out there that is non-institutionalized. It's fragmented. You could get some really interesting returns, great fundamentals that are out there, and big LPs don't yet have tremendous access to them. So that's what I'm interested in, broadly speaking.
So how much time do you spend trying to identify those new, I'll call them new, they're not really new, but
They're
different,
right.
the non-traditional asset
Non-traditional,
classes?
right. They're not new,
Yeah.
but it's like all of a sudden you see them.
They haven't been at the forefront.
Exactly.
Yeah.
So these LPs invest with you so you can find out these niche strategies. That's the strategy.
That is half the strategy. The other half is sort of like, you know what? Some of the teams that they're working with, like the GPs they're working with, maybe it's time for them to move on, or maybe they want to find something else. So it's not only like, sometimes it's like, I've been surprised where there was some, I call them more traditional strategies, more traditional industrial, more traditional multifamily, with the team was just amazing. And they were just better than some of the bigger shops. So we invested with them.
But if those teams aren't nimble and they're not seeing the future, you need to move on.
Correct.
I see.
Right. So and I think one of the benefits of having this open door policy, I mean, it's hard because you see so many groups, is that we do a lot of our own research. It's amazing when you talk to people out there, they come in and they're like, all of a sudden they talk about something like, oh my God, I didn't see that before. It's out there all the time. I drive by that type of stuff all the time. I missed it. That's cool. And so that happens a lot. And then the question is, okay, but can we make that an institutional product? Can we actually manage this stuff? And we've had an experience now where we say, we think we know yes or no. Like we could figure out if we can do this or not.
So everyone knows about self-storage. Everyone knows
Yes.
iOS,
Yes.
student housing. Tell us a secret. What's the next one? What are you looking
Or
at?
what has come across your desk that you said, I haven't seen that before?
Well, I'd say a broad one is honestly things that are more technology enabled. So
Are we talking data centers or not necessarily?
No, not
Because some people
necessarily.
think they've almost run their course.
there's a lot of capital chasing it. So
Yeah.
it's a kind of you have to be careful. But I understand the fundamental story behind that. By technology enabled, I mean, like, it's remarkable today how technology is transforming just our basic lives, but finally transforming real estate. So you could optimize your revenues, you could rationalize your expenses, you could be much, much better about sourcing, much, much better about how you kind of execute a deal in ways that generates hundreds of basis points of incremental return. And so we spend time with that. We spend time investing in prop tech.
I was going to say prop tech is where you're going.
Yeah, and so we've done this with a couple of different groups. There's some groups that are sector specialists, like there's a group that we work with that does, I know it's going to sound funny, it's just parking. It's like van parking, truck parking.
Yeah.
But you know what? Their technology that they use and the opcode that they've built or bought into, and
Parking has now reached a sophistication level that's amazing.
amazing.
So,
Yeah.
so Peter, so does the prop tech investment come out of the real estate group or the private equity group?
So
Or are you guys battling that out?
it's a great question. We know we're doing it, and they're saying,
Have at it.
have at it. You know,
right,
let
good.
us know how this goes.
You guys test it. Let us know if it's
A
good.
test run. Take it out for a test run and we'll
The
see.
one thing that's nice about Grosvenor, I mean, there are many nice things, but we have, like, so we sit on investment committees together, we talk about each other's stuff, and if a deal makes sense to a couple of different groups, like, we partner with our infrastructure team a lot. Yeah, because there's more of a blurring of line of infrastructure and real
assets, sure, yeah.
That we'll be like, well, let's just do this deal together. Like, why not? So they're happy to let us do it, and we kind of, and honestly, a lot of that's also the strategic nature of what we do with our LPs. Some of our LPs want us to do this. They want us to do this because it's harder for them to do it.
Right.
For them, it's not going to move the
They're
needle.
looking to you to do that.
Right,
Yeah.
because it's a small investment from them. But for us, it's like, it's interesting, it's meaningful, and you can see it. So we've done sector specialists, we've done generalists, have done it, like moved different asset classes using technology. So that's a broad place that we're seeing it. And we're seeing so many different applications. It's really interesting.
So for you in your spot, it must be so rewarding to be in a platform that is open-minded and gives you room to grow.
It's awesome. Yeah, they really let us do what we want to do.
This episode of Elevator Pitch with Jonathan and Mitch is made possible in part by Pearl House. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
What solutions are you looking for? What are you trying to solve?
Yeah. So this is kind of where the business, I think the broader business is going. So LPs have gotten more sophisticated and they need access to these new teams and these new real estate asset classes. GPs are, fighting in an environment where, as we talked about, there's absolutely more consolidation. They need to prove themselves like as a standalone viable business. Or not. They need to maybe find a solution where they merge with somebody else. So where I look for us is like, yeah, I want to be part of that whole thing. I want to be a solution to our LPs and our GPs in terms of where they're all going. I'm trying to stay ahead of it.
Are the solutions your LPs seek, are they competing, particularly with the new sources of dollars that are coming in?
They are. And so one thing I've been saying a lot lately is like, watch out, because you have to respect what's happening in like wealth capital and insurance capital. So the RIAs are consolidating, are growing. They're like $100, $200 billion multifamily offices now that are deploying capital and they're building up their alternatives. And it hasn't come yet. It hasn't hit us yet. But when that money starts really coming in, and we're seeing it start to come in more and more,
You're bringing it in yourself?
we're looking at it for
Okay.
sure. And many other investment managers are building out or buying these distribution platforms because the institutional investors, subset, I wouldn't say it's tapped out, but it's mature. And so if you want to grow, where are you going to grow your capital? You're going to either, you're either going to, go into the, get insurance capital. Look at KKR. KKR was 50 billion, I'm going to get these numbers wrong. 50 billion 15 years ago, they're over like 600 billion today. They were like 70% institutional capital then, maybe less than 25% now. Again, I'm broadly wrong,
Well,
but
they're
generally right.
not building new pension funds.
No, that's right. So where are they
No,
going
but
to
that's
go?
a sign where the industry is going.
Right, and so the result is, what's a GP going to do? They're going to look for new capital sources, and they're going to look for new products. Where they get new products, they're going to buy other investment management firms. So you're seeing that's where the consolidation is happening. So you're seeing a lot of it in the newspapers, a lot of these firms going out buying smaller firms. Actually, some of them are not small. Some of them are like, $20, $30 billion
We've
platforms.
seen recent mergers.
We have. And they're just saying to themselves, I don't know, either I got to buy or I'm going to sell out. And for a founder or the next generation, they're like, yeah, maybe it's time.
Well, they're smart enough to see the handwriting on the wall.
Right. And so they're going to be like some very big winners or big shops. And then the middle ones are going to be the ones that are challenged. And then the small ones are going to be the innovation. That's going to be the fun stuff. That's going to be where the new alpha is, where the new asset classes are found. And they're going to either grow to become massive firms, or they're going to, bolt on to some other place. And so for us, I want to play that role, whereas help them grow, help them figure out the right strategy, where to move. And then, because we're going to see all of it. We're going to see all the different groups that are out there. And then for the LP side, we're going to do the same thing. Like, we're going to help them say, like, how are you going to compete with these other capital sources? How are we going to find the next best generation of groups for you to invest with? And what's the best structure? So when you say what kind of solutions, it's not funds, it's not just GP co-investing, it's not just platforms, it's all of it. It's broadly GP solutions to say, like, what's the best way to grow and kind of fund themselves.
Look how much fun he's having.
I mean, my gosh, you
amazing.
know what I've learned? Peter Braffman is the solution.
You.
So for viewers who are listening to this and they're taken in because it's a compelling story, it really is, and you're obviously having a lot of fun and enjoying what you're doing, what should someone consider if they're trying to forge a career path to get closer to what you're doing?
So I'm always a big believer in, like our business is broadly an apprenticeship business, right? You go to all of us, right? We went somewhere, we learned, we worked with some crazy people.
Nothing like a good mentor.
There's nothing like a good mentor.
And there's also nothing like a bad mentor.
No, you're right.
Yeah.
You learn. You
get
learn.
stuck.
That's
Right.
for sure.
I tell my kids all the time, just start.
Yeah.
And then you learn and you get skills. And so be patient. Like I think some of the biggest mistakes some people make,
Right.
they start too soon. They just they want to get out there. They're like, you know what? I've done my 2 years, I'm ready. It's like, you're not.
And they're seeing 3 of their classmates that have done this, that,
Of
and the other
course,
thing.
and that's
but-
going to happen.
Yeah,
But
yeah.
you know what? Great, good for them.
Exactly.
Right? Build your skill set, build your connections, build your network. And honestly, this is another thing, build a little wealth. Like enough so that, because if you want to start
Have
your
a
own
cussion.
business, have a cushion.
Yeah.
I work with some groups that just, it doesn't work out and it's so painful. And it's just like, I hate seeing that. And that's just the reality. So build some cushion and also don't do it alone. This is a hard thing. Like, if you need to do it alone, do it alone.
But that's easier said than done.
Totally.
How does one find a mentor? I mean, that's the great trick.
Oh,
It's a great trick.
I think, Peter, what you said, we're going to make mistakes.
We're going to make
We're
mistakes.
going to
And
make
that's okay.
mistakes.
That's the other thing. Be very
Right.
comfortable with the mistakes. Like I say it all the time when I talk to different LPs, prospective LPs. I'm very upfront with the mistakes that we've made.
Yeah.
I still remember one of the best meetings I had with one group that has gone on to spectacular success. Like their tracker was good, but not great. They had some bad moments, but they came in right at it. Not like fake lessons learned, but great lessons learned. And I saw exactly what they were saying. That's okay. So learn the lessons.
Yeah, dust yourself off. Right?
Dust yourself
Yeah,
off. Move
yeah.
on and show. And so then
And don't wallow in it either.
and don't wallow.
It's a marathon, not a sprint. How's
Yeah.
that? I just made that
Did
up.
you make that up? You should trademark it.
No,
Yeah.
but it's true. It's true.
Yeah.
So, Peter,
That's
we're
a big-
going to...
Perspective is tough, but we have it because we have a few more years under our belt.
We do, and I just see it. You see it in the teams that come, but then I mean, this is the other thing I'd say. There's so many lessons, but you really need to build a business plan. Like, really need to think, talk to people, get advice. People will talk. They want to talk. They want to share.
Don't go it alone. Don't go it
Don't.
alone.
Actually, you find that people want you to win.
They do. They actually do. Like, so many of our GPs talk to each other all the time. They're not really, they're competing, but they're not really competing. And they help each other out all the time. And the ones that I really like come in with, like, I joke about this, is like, it's an Excel model. It's 30 tabs long. It's a 40-page document of this and that. It's like, it's perfectly and precisely wrong because none of it's going to work, right? But they've thought about it. They really thought about it. They sensitized it. They said, well, what happens if this? And what's the velocity of revenue I need to achieve? And they've thought it through. And they've talked to people and they've built their models. And I'm like, okay, this is someone who's serious. They really thought it. Do that. And then once you start doing that, you know, am I up for this thing? Can I do this? And then we should talk.
That's incredible. What an incredible story. And what an incredible
fabulous.
guest. But we have a couple of more questions for you
yes.
as we close.
Are we ready for the lightning round?
Not quite, but I do have one question that I always like to
Please.
ask. What are you reading these days?
Oh, gosh. That's a very interesting question because I'm not.
That's okay. There's not...
No, I used to be a voracious reader. And, you know, what I do read now is just more, honestly, trade stuff. Like, I just don't really have, there's no book I'm reading right now. Or anything
Let
like
me
that.
take a twist on that. What are you doing to relax?
My wife and I, we're voracious walkers. So we walk and explore the city all the time. We love watching like some fun stuff on TV together because for 25 years I stopped watching TV other than the kids stuff. So that's been kind of fun. And we visit our kids all the time. So that's nice.
Oh, well-rounded life.
I think so. And we work out. So that's good. Have to.
All right. That's wonderful. You want to go to your lightning round now?
It's time.
It's time.
For our lightning round.
Lightning
Okay.
round.
Okay, 3 quick questions. We
Yeah.
need quick answers.
I'll try.
Okay?
Yeah.
James Bond or Austin Powers?
James Bond.
Nice. When you're at the movies, candy or popcorn?
Both.
I guess that's a man that I. Well, okay.
Is it better to be lucky or good?
More lucky than good is probably, like, good's essential, but lucky, you don't get anywhere without the luck.
And if I can add, you're best if you make your own luck. Work hard.
Oh, for sure. Like, I don't want to minimize working very hard and being excellent at what you do. But look, we talked about this before, like, we start our careers at a very special moment. And so we were kind of lucky. And so I guess it's more about humility. Like, I just know that I look for the future for my kids. It could be a wonderful future. It's going to be harder than it was for us.
Well, Peter, thank you so much for giving us your precious time.
Yeah.
This has been enlightening, eye-opening, compelling, and we can't thank you enough.
I'm honored. Thank you for doing this.
We want to thank Peter Braffman for joining us on Elevator Pitch with Jonathan and Mitch.
We'll see you next time.
Lifting real estate, one story at a time.
This episode of Elevator Pitch with Jonathan and Mitch was made possible in part by Pearl House, a Van Barton Group holding.